Good afternoon, everyone. Welcome to the TheoTrade evening video. I am Blake Young. Today is June 8th, 2023, and today we're going to discuss real data revealed, unmasking economic revisions impact. What do we mean by this? We mean, what are we seeing in revisions in the economic data? What are we seeing after the fact? Every time there's a new economic data, we see the market reacting to the difference from what was expected to what was reported. But the problem with that is that we're not addressing the fact that we're getting better data later. Well, when I say better data, more accurate data later on. So as we're looking at this, the main thing I'm talking about is this previous number changing colors. If we're on the Forex Factory, and we'll look at it directly from the BLS website here momentarily. But what we're looking for is we're saying, okay, we are seeing that the previous time frame was changed. So we have the report, and this report number will just shift over to the next report time. If it's different, then it'll change either to red or green. And so when we're noticing the difference between the data, we're noticing that these numbers are better. This number is worse. This number is better. Now, looking down the list, you can see there's a number of reds and there's a number of greens as far as revisions to the previous report. But what is the data telling us? If we look at consumer confidence, if we're looking at the market and saying, what are we focused on? Right now, we're focused on the upcoming Fed meeting next week. If we look at the consumer confidence, would a more confident consumer be an indication of cutting rates, leaving rates unchanged, or raising rates? Well, clearly, it would be an indication that we're going to raise rates again. Because if the consumers are buying, if the consumer is keeping the economy strong, if the economy is hot, then we're going to likely raise rates again. If we look at the JOLTS, job opening and labor turnover, not only did we beat expectations, we revised the previous month higher. So that means there's not just a confident consumer. That means that we were even more confident than we were previously thought. It also means that there's more job openings and availability to be hired and grow than we thought. And we've raised it up to 10 million. So as much as we have maybe 5 or 6 million people unemployed, we have 10.10 million job openings. And we actually had more job openings last month when we said, maybe it's slowing down. Maybe the job openings are cooling down. And so what are we seeing? We're seeing more confidence, more money, more spending. And if we're looking at the more confidence, more money, more spending, that would justify raising rates again. If we drop down to the average hourly earnings, notice we reported a better income. But that better income for the average hourly wages was revised lower. In fact, you can click on this little line to the next, and we're going to slide it over just so we can focus here. And we don't care about the forecast. We care about what was reported and what was reality. So last month we said we were increasing our pay by 0.5%. And that would say, look, we have all this money. We're getting paid better. But if we look at the revisions and put that on, you can see that we revised lower last month. We saw that slide. If we look at non-farm payroll, we increased the number of people that were employed. So all the data says we are justified to raise rates further, but we're making less money, or we're seeing less of a growth of our wages than what is being shown in the charts. Dropping down to the unemployment claims from this morning. We see weekly unemployment claims. This is telling us that we have 233,000 people filing for unemployment last week. We have 236,000 applying, or expected to apply this week, and we actually had 261,000 apply. So how is it that we have more jobs available, more people being hired, more people being employed according to the non-farm payroll, and more being employed from the previous month and adjusted higher, revised higher? So whatever data we got, we already reacted to it, and we're not reacting to the revisions. We have more people employed, but yet we have more people getting unemployment. What is going on? What are we really seeing? If I go to the BLS, Bureau of Labor and Statistics, go directly to their page, just looking at the data, you can see payroll employment increases by 339,000 and unemployment rate rises. So we are absolutely seeing more people apply for unemployment benefits while more people are being hired. Remember, the unemployment benefits that we're showing here are new people that have reached the time where they've been unemployed long enough that they can apply. And so we're seeing more people apply. And so even if we are increasing the number of total employed, we're also still seeing people being laid off. Additionally, you can see that the labor cost, productivity decreases by 2% and unit labor cost increases. So what does this tell us? When we're looking at the changes in the data and the revisions, we're seeing that we are becoming less productive for the time spent, the hours spent. We're producing less products by 2%, and it's costing us 4% more. So it costs us 4% more to produce something, and our productivity is decreasing. So we're making less, and it costs us more. Here we have a situation where, theoretically, we should be super confident, we should be raising rates, we should be seeing an economy grow, and yet we're seeing unemployment rise, our productivity fall, and costs go up. And if costs are going up, then we know that the costs and expenditures are going up across the board, and that means inflation is still in play. So all the justification to raise rates. Now, I will save the raising rates discussion for next week, because then we'll be past the rate decision. There's a lot of speculation there. We'll talk about that more next Thursday. Now, what am I seeing? In non-durable manufacturing, we reported that we had real hourly compensation increase by 1.8%. Reality is, when we adjusted for inflation and we revisited it, we revised the number, it was dropped to negative 1.7. That's a 3% differential. We're decreasing our hourly compensation from what is reported to negative. Flat, we'll call it negative, but flat here to negative. Positive to negative, positive to negative, positive to negative, positive to negative, all the way through. And as we're looking at this, the data is showing that our hourly compensation, what people are getting paid as consumers, is not growing, is not climbing. In fact, we're reporting good news, and then we're hitting the revisions with bad news. We're hiding the revisions. We're providing the real data in the revisions. So the revisions are showing us that we're actually losing money. We're actually losing spending power, regardless of whether we're employed or more employed. We have more people filing for unemployment. We have more people in this situation. We have more people in this situation losing their spending power than what is being reported. So what happens? Everybody focused on the publication, the report on the day of the employment data. Positive, positive, positive. We're making more. Employment wages are catching up with inflation. But when we look at this and we adjust this, we are seeing negatives all the way across the board. We could do the same thing with productivity, labor productivity. We're not only not paying our people, we're seeing that productivity is reported one thing and worse, reported one thing and worse, reported one thing and worse, again and again. Only the top two, which came in as expected and revised to stay the same. Everything was terrible fourth quarter of 2022. We can do the same thing this first quarter of 2023. We reported non-durable manufacturing. Real hourly compensation was positive, is negative. Worse, 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 worse. Every single report has revised lower quarter over quarter over at least the last 2 quarters. And we're losing money. Spending power and purchasing power of the consumer is losing. We are making less money per hour when we adjust for inflation. We are not catching up to inflation, even though the data would show that we are initially on the report show that we're okay. We're in line with inflation. We're trying to catch up. Reality is we're seeing a massive loss. When we adjust for hourly compensation for real time, we're negative 5%. That was last quarter. We're negative 1.7% this most recent quarter. This is not a good thing. So now we have lower purchasing power across the board. If you've gone to dinner, you know this is the case. Everything costs more and your dollar doesn't go as far. Even if you've seen a payroll increase, ask yourself, have I seen a 10% payroll increase over year, or at least 6% to adjust for inflation? And I doubt very many people can say that you've seen an increase in payroll by 6%. So as you know, I love to look at the S&P versus all the sectors and look at the correlations. If we know that our money is not going as far, if we know that our wages are decreasing when you adjust for inflation by 4%, 5%, last quarter another 2%, what will that do? It will have a significant impact to the way we spend money. Now, certainly there's sectors that are super aggressive and bullish. This is investment behaviors. But when we get down to true demand, this will start impacting some key areas. And we can look at the very top. You can still see XLK and XLC are way at the top. Those communications and technology are way up here. You can see right behind that You have consumer discretionary. Consumer discretionary will likely peak, and we will likely see consumer staples climb. But I think there's some other more specific targets and specific setups that we can look for. We can look down at the lowest of the low. Financials are the weakest, and we're not expecting that to change. Energy is still low cost, and basic materials are still down here as well. So we're looking to say when these climb, that would tell us that demand's picking back up. We don't have the demand picking up. Energy's low, basic materials low. What we're looking for again is, what do we substitute? How do we change the behavior? Now, I took my son to his birthday dinner yesterday, went to a nice restaurant, and besides us, there was only one other table with people at it. It was a little bit early. I mean, not super early, but it was, 7 o'clock. And there's one other person, one other group in the restaurant. And so we're starting to see a shift. We're seeing that move away from spending higher money on higher ticket items and higher money on restaurants to probably more fast food restaurants. So what are we looking for? Here's XLP, consumer staples. You can see we have a lovely little bounce off of a support level at the area that we'd be looking for buyers to step back in. I like consumer staples for a long position. I would also say what we should be looking for is probably XRT, retail, to create a peak. You'll also notice that we're approaching 2-month highs and have been very, very aggressive in the climb, but I'm looking for a short here. So the opportunity might be to buy consumer staples and sell retail. Here's retail right through there. And looking for this to bounce and go back up, possibly letting the funding of selling retail pay for the cost of buying consumer staples. And if we're looking at this and it doesn't look like that big of a move, but from going from a 10 to 10 or 16, that's a 60% increase on a pairs trade. We can do it into individual stocks as well and make that comparison. For example, yesterday I was at a nicer restaurant. We could take a look at Darden. Darden near its highs, while we're looking at the bounce up in McDonald's. Here's McDonald's creating an engulfing candle, embracing that or engulfing that previous candle, pushing higher, and McDonald's could easily go up to 300 again. DRI, if it is bouncing and near its highs, could it fall back down? Let's take a look and do McDonald's. We'll look to go long McDonald's and short DRI. Now you could do 2x DRI, 2 times DRI. But if we're setting this up right, this could be the buy at support right through here, and a bounce at 120 could see 140, could see 145, could see 150. Now that's not nearly as large of a percentage return as we saw on retail versus consumer staples, but I like this one. I like the idea that when we see that our money is not going as far, when things cost more, what do? We step to the sidelines. We don't buy into those key markets. We buy into McDonald's, Subway's, Burger King, and the fast food chains. So those will be supported in the next rally and pushing us back up to the 150 or potentially higher. At least that's what I'm looking for. That's my expectation, is we're looking for that return back to 150. Now, $30 return on 120 is about 25% return. And as long as we see that our money is not going as far as it has in the past, these types of patterns should continue. I've already brought this up. Start looking for opportunities to sell the higher end items. Start looking to sell the Nikes, and this will be a continuation. Sell into Nike, sell into Lulu, sell the Lulu, nice gap up and fading back down, headed back towards 329, while you look to buy things like Ross. Ross, dressed for less. Now Ross is near its support level. I think this is a discount opportunity to buy Ross and to sell some of these other things. What if you were to do a buy Ross? We'll do it 3 times Ross minus Lulu. I need to go one more. We'll go 4 times. So if we're buying here, if we're playing that same game, what would we'd be looking for? We'd be looking for buys near 58, looking for a return to 80, possibly even getting back up to this 140, just back into the March price levels. Now we're talking about a 100 to 150, even 200% return on buying the discount stores and selling the more expensive retail stores. I do think these are going to set up, and these are longer term trades. These are not just a day, but they're weeks and months, and that could feed into this as the economy continues to readjust our spending habits because the costs have gone up to produce things while our purchasing power as individuals has gone down dramatically. Well, that's going to do it for me today. Have a great day, everybody. We'll look forward to talking to you next week, and see you then.